Today, we are doing something a little different. I want you to picture your phone screen for a second. You open Instagram, maybe TikTok, and what do you see?
You see the highlight reel.
Exactly. You see the Instagram rich, the rented Lamborghinis, the, stacks of cash on a hotel bed, the guys screaming at you to buy their course on how to drop ship vitamins. It's loud, it's flashy, and honestly, it's exhausting.
It is the whole industry of signaling.
Yeah.
And usually the louder the signal, the less actual wealth is behind it.
Right. But today, we're asking a specific question based on this massive stack of research you pulled together.
Right.
If we delete the lottery winners, if we ignore the trust fund kids, and if we just mute the reality TV stars, what actually separates the self-made wealthy from the average person? We're not looking for the loud millionaire. We're looking for the quiet millionaire.
We are looking for the signal in the noise. And to do that, we've combed through a really, really diverse mix of sources today. We have candid street interviews from the School of Hard Knocks with, actual self-made billionaires.
Really? Just on the street?
Yeah. And then we have deep psychological research from Dr. Jim Grubman on how wealth impacts identity, and reports on family office leaders, the people who manage generational money, behind closed doors.
And the mission here is pretty clear. We want to debunk the idea that wealth is just luck, or that you need a silver spoon to even start the game.
Yeah.
We're going to look at specific behaviors, the actual math of how money grows, which is different than how we think it grows, and this really crucial psychological idea of immigrating to wealth.
That's the key. We are stripping away survivorship bias. We are not interested in the guy who bet his life savings on a single meme coin and got lucky. That's not a strategy.
That's a lottery ticket.
It's a lottery ticket. We are looking for reproducible behaviors that anyone, regardless of where they start, can actually study and maybe apply.
Okay, so let's start with the elephant in the room, the biggest cynical take on wealth. You hear it all the time. The game is rigged. You had to be born rich to get rich.
Well, it's a very comforting thought, isn't it? Because it absolves us of responsibility. If the game is rigged, why bother playing, right?
Right.
But the data actually pushes back on that hard. We looked at research discussed by Dr. Jim Grubman. He's a renowned wealth psychologist, and he cites these demographic studies showing that roughly 80% of wealthy individuals are self-made.
Hold on, 80%? That sounds incredibly high. Are we talking about billionaires or just, your local millionaire next door?
It covers the broad spectrum of high net worth individuals. Now, definitions of self-made can vary a bit. Some might have started with a small loan, others with absolutely nothing. But the core finding is that the vast majority were not born into the wealth they currently hold. They built it.
Okay, so if 80% of wealthy people are essentially new to money, that creates a weird dynamic. They weren't raised knowing how to handle it.
Exactly. They didn't grow up with lessons on estate planning at the dinner table. And this is where Grubman offers what I think is his most brilliant insight. He calls these people immigrants to wealth.
I saw that in the notes, and I absolutely loved it. It just reframes the whole conversation. Break that metaphor down for us.
Well, think about moving to a foreign country. Let's say you move from a small town in the U.S. to, Tokyo. You don't speak the language, you don't know the customs, you don't know the unspoken rules, how to bow, how to exchange business cards, what's rude, what's polite.
Right. It's total culture shock. You feel completely out of place.
Grubman argues that moving from a working class background making, say, $40,000 a year, to having millions in assets is psychologically identical to that move. It is a different country. The language changes from budgeting and coupons to things like asset allocation, tax efficiency, estate planning.
And the customs change, too.
Drastically. In the working class, the custom is often immediate consumption. You earn it, you spend it to survive. In the land of wealth, the custom is preservation and investment. If you bring your old customs to the new country, you fail.
But usually when people talk about immigrants, there's this struggle to assimilate, attention. Does that happen with money?
Absolutely. Grubman identifies a group he calls the avoiders. These are people who make the money. Maybe they built a plumbing business or had a sudden liquidity event, but they suffer from intense cognitive dissonance.
Cognitive dissonance.
It's that uncomfortable feeling when your reality doesn't match your beliefs. They grew up hearing rich people are greedy, or money is the root of all evil, or
Filthy rich.
filthy rich. So now they're the rich people. And to cope, They reject their new identity.
So they are rich, but they pretend they aren't.
Exactly. They
Okay.
hide the money. They refuse to learn the language of investing. They might keep hundreds of thousands of dollars in a checking account, earning zero interest because the stock market feels scary or, elitist.
They're living in the new country, but they refuse to leave their hotel room.
That's a perfect way to put it. And from the outside, you'd think, oh, they're just being humble. But it's not humility. It's fear.
Fear of what?
Fear of judgment and fear of losing their old identity. And Grubman argues that to really sustain wealth, you have to integrate. You keep your old values, hard work, family, the stuff that got you there, but you must learn the new skills. You have to become a citizen of this new place.
It's an identity shift, not just a financial one. You have to accept, I'm a person who builds wealth without feeling guilty about it.
And we can actually measure the difference in where people start. Forbes has something called the self-made score for their 400 list. It runs from 1 to 10. A score of 1 is someone who inherited a fortune and is basically just trying not to lose it.
The classic, born on third base and thinks he hit a triple crowd.
A little harsh, but yeah, pretty accurate. A score of 10, however, is someone like Oprah Winfrey or George Soros. People who grew up in poverty, faced systemic obstacles, and built everything from zero. The point is, wealth isn't a monolith. It's a spectrum.
Okay, so we've established that most wealthy people are these immigrants who had to figure it out. So let's pivot to the mechanics. How do they actually do it?
Yeah.
Because you pulled these street interviews from Philadelphia. And I'll be honest, usually those interviews are just fluff. But there was this one couple, retired dentists, who dropped a serious math bomb.
They were my favorite part of the research stack. Totally unassuming, looked like regular grandparents. But the husband said something that perfectly captures the mathematical difference between high income and high wealth. He said, money doesn't grow linearly. It grows geometrically.
Geometrically, that sounds like high school math coming back to haunt me. But it's crucial. What does that look like in practice for someone listening who makes a regular wage?
Think about how most of us are trained to earn. You work an hour, you get paid for an hour. You work a year, you get a salary for a year. That is linear. If you graph it, it's just a straight
But
line.
if you stop working,
The line stops dead. That's the hamster wheel. You run, the wheel turns. You stop, the wheel stops.
right.
But the dentist couple, they moved to geometric growth. They mentioned investing in index funds. They specifically name-dropped Vanguard, which is great because it's so accessible. When you invest, your money earns money. Then that new money earns more money. That's compound interest.
We all know compound interest is magic. We hear that all the time. But the dentist said something interesting about the feeling of it. He talked about the flat part of the curve.
This is the valley of disappointment, and this is where most people quit. In a geometric curve, for a long time, years, maybe a decade, it looks flat. You are saving, you're investing, you're driving an old car while your friends lease new ones, and it feels like nothing is happening.
It feels futile. You put the money in, and it barely moves. You think, I'm sacrificing this vacation for what, an extra $500?
Exactly. So people cash out, they buy the boat, they upgrade the lifestyle because they want the reward now. But the dentist said if you wait, if you survive that flat part, the curve eventually explodes upwards. That's the hockey stick moment. The math takes over, and suddenly your returns are making more money than your salary.
This reminds me of that Morgan Housel analysis of Warren Buffett you included. We always think of Buffett as the greatest investor of all time, right? The Oracle of Omaha.
Yeah.
But Housel argues he's not actually the best stock picker.
He's really not. There are hedge fund managers who have had much better annual returns, people like Jim Simons. But Buffett is the richest. Why?
Time.
Time, the duration. Housel points out that 99% of Warren Buffett's wealth was accumulated after his 50th birthday. He started investing as a kid, and he never stopped. He's in his 90s now. That is 80 years of geometric compounding.
That's insane. So if he had retired at 60 like a normal person?
Nobody would know his name. He would be a very comfortable, obscure rich guy in Omaha. The lesson isn't be a genius. The lesson is don't interrupt the compounding.
It's a test of character, not IQ. Can you sit through the flat part of the curve without touching the money?
That's the real barrier to entry. It's boredom. Can you tolerate the boredom of doing the right thing for 30 years?
I love that. Wealth is just a high tolerance for boredom. But there's another layer here. It's not just about saving what you earn. It's about how you earn. We have this article by Tim Denning that attacks the concept of renting your time.
This is critical. Denning interviewed over 50 millionaires, the common thread. None of them relied solely on renting out their time. Even high-paid people lawyers, specialist doctors, are still renting time. Their upside is capped. There are only 24 hours in a day.
You can't bill 30 hours no matter how good you are. If you get sick, the income just stops.
Exactly. To break out of that linear trap, you need leverage. You need to detach your income from your time. That means owning assets.
Now, when we say owning assets, I feel like people immediately jump to, I need to found the next Facebook, or I need to build a tech unicorn. But Denning says that's the wrong way to look at it.
Right. That's the Instagram rich narrative again. Denning found that real sustainable wealth often comes from incredibly boring businesses, saturated markets.
The unsexy economy.
The unsexy economy. You don't need a revolutionary idea. You just need to execute a boring idea like HVAC repair or logistics or specialized plumbing 1% better than the competition. Or, you keep your day job and you buy boring assets like rental properties.
There was a great story in the street interviews that illustrates this mindset shift perfectly. The filmmaker.
Oh, the guy who was an actor, that was a powerful story.
Yeah. He tells this story about being in an audition, standing in line with 50 other guys who look just like him, terrified of rejection. He's rehearsing his lines, he's sweating. And he looks over and sees a guy on the phone, looking relaxed, probably eating a bagel. And he asks someone, who is the fat dude with the phone?
And someone tells him that's the producer.
And the light bulb just goes off.
A moment of pure clarity. He realized the actor is the labor. The actor is renting his time, begging for a gig, hoping to be picked. The producer owns the project. The producer hires and fires. The producer builds the asset that keeps making money long after the filming stops.
And he decided right then, I need to be the producer.
It's a shift from being the labor to being the owner of the capital. And you can apply that mindset anywhere. Are you just completing tasks at your job, or are you building systems that have value? It's about ensuring that you aren't just trading hours for dollars until you die.
But Denning also throws a flag here. He warns about the trust fund job.
Yeah, this is important. Sometimes we see people who look successful, but they have a fake job created by their parents, VP of special projects at daddy's firm.
They skip the struggle.
They skip the struggle, and that is actually dangerous. Because they skip the struggle, they lack resilience, they never had to survive the flat part of the curve. Denning argues that these people are actually fragile. Real wealth building requires a level of grit that you only get by overcoming the friction of the early days. If you haven't been punched in the mouth by the market, you don't know how to take a hit.
So we've got the mechanics. Don't rent time, own assets, let them compound, and survive the boredom. Now let's pivot to behavior. Once you have this wealth, how do you act? Because the stereotype is the Wolf of Wall Street. Loud, brash, taking huge risks.
And that makes for great movies, but it's a terrible long-term wealth strategy. We looked at a report from Russell Reynolds Associates on family office leaders. These are the people managing hundreds of millions, sometimes billions, for ultra-wealthy families.
The bros managing the old money. What do they look for?
The traits they identified were the exact opposite of the Wolf of Wall Street. They found that successful leaders in this space are defined by quiet confidence. They score very high on humility.
Humility. In high finance, really.
It's a survival mechanism. If you are arrogant, you think you can predict the market. If you are humble, you respect the market. Right. They are willing to say, I don't know what I don't know. They are risk conscious. They think in generations. How does this affect my grandkids, not just quarters?
That connects to that other billionaire in the street interviews, Alan Dom, the private equity guy. He didn't even want to be interviewed initially.
Which is a signal in itself. He wasn't chasing clout. But when he did speak, he gave advice that aligns perfectly with this. He said, it takes 20 years to build a reputation and 5 minutes to kill it.
5 minutes. Wow, that's terrifying.
But it's true. In high-level business, contracts are important, but reputation is the real currency. If people know you're honest, deals flow to you. If you have a reputation for cutting corners, everything becomes harder. You pay a trust tax.
He had a specific rule I liked. Deliver bad news quickly.
I love that rule. It's so counterintuitive. Our instinct is to hide mistakes, to bury the bad news and hope it goes away.
Right. I'll just patch this hole and nobody will know.
Exactly. But Dom is saying, no, own it immediately. Call the investor and say, here's the problem, here's the bad news, and here's how I'm going to fix it. That builds immense trust. It shows you have integrity. That is how you sustain a career for 40 years.
So let's zoom all the way out. We're doing all this work. We're saving. We're investing in boring index funds. We're protecting our reputation. What is it all for? Does it actually make you happier? Because we have a really interesting counterpoint here from an inventor, Gary Michelson.
This is the so what of the episode. Michelson cites a famous study of lottery winners. They tracked people who won massive jackpots, life-changing money, and they checked in on them 22 years later.
You'd expect they'd be blissfully happy on a beach somewhere.
You would. But statistically, they were no happier than they were before they won. Some were actually unhappier.
Wow, 22 years is a long time. That suggests that humans just adapt to whatever baseline we have.
It's the hedonic treadmill. We get used to the nice car, we get used to the big house, it just becomes normal. But Michelson points out a crucial nuance here. Money is incredibly effective at removing the stress of survival.
Right. If you can't pay rent or you have medical debt, money buys a lot of happiness.
Exactly. If you are worried about the electric bill, money is relief, it's peace. But once those baseline needs are met and you have a bit of a safety net, the curve just flattens out completely. The difference between having 10 million and 100 million in terms of daily happiness is basically zero.
Warren Buffett talked about this. He used the economic term utility.
Right, he said, incremental wealth has no utility to me. Think about it. He can't eat more than one dinner. He can't drive more than one car at a time. The utility of that extra $1 billion to him personally is zero.
But he said it has incredible utility to others.
And that is the final evolution of the quiet millionaire. You go from accumulation to distribution. Buffett and Bill Gates started the Giving Pledge to encourage billionaires to give away the majority of their wealth. Not because they are saints, necessarily, but because they realize the money is better used solving problems like polio or education than sitting in a vault.
And it's not all dour and serious. I love that Sarah Blakely, the founder of Spanx, is part of this group.
She's great. In her interview, she cracked a joke about it. She said, I made all this money making other people's butts look better.
Which, to be fair, is a valuable service.
Huge utility. But her approach is serious. She's using that wealth to empower women and support female entrepreneurs. It shows that wealth allows you to project your values into the world. If you are an immigrant to wealth, eventually you stop just trying to survive in the new country and you start helping to build it.
I think that's a beautiful place to land. So let's try to summarize this deep dive. We've stripped away the glitz, the rentals, and the noise. What is left?
First, realize that wealth is a transition of identity. It's an immigrant experience. You have to learn the language and not be an avoider. Second, you have to respect the math. It's geometric, not linear. You have to survive the boring, flat part of the curve.
Third, stop renting your time. Shift your mindset to ownership, whether that's buying stocks, real estate, or starting a boring business. And fourth, protect your reputation.
Because it's everything. And finally, remember that money solves survival, not happiness. The goal isn't just to have the biggest number, it's to have the freedom to do things that have utility.
So here's the aha moment for me. We look at the rich and think they have some secret knowledge or they got a lucky break. And sure, luck plays a role. But the barrier to entry is largely behavioral. It's the discipline to be the producer, not the actor, the investor, not the spender, and the patience to wait for decades for the math to work.
It's simple, but it's not easy.
So we want to leave you with a provocative thought today. We talked about how becoming wealthy is like immigrating to a new country. So ask yourself, are you currently learning the language of that country? Learning about leverage, compounding, and patience? Or are you just trying to be a tourist, looking for a souvenir and a quick photo op?
Are you planting roots, or are you just passing through?
Something to chew on. Thanks for diving deep with us.
See you next time.